Welcome back to our intermediate financial accounting class. We've been talking about the conceptual framework of US GAAP. We've talked about where financial accounting fits in. We've talked about how we're converging with IFRS. We've talked about the conceptual framework and why we created it, and we started going through the conceptual framework. So we've done a lot in this last little while. And again, all this is important so that as accountants or non-accountants, you understand these basics and can use it appropriately. Now, in our last segment, we talked about the objectives that underlie all of the conceptual framework, and then we started talking about the characteristics that we want each rule, each process to contain. We talked about relevance and reliability. We talked about comparability versus consistency. We talked about understandability for those that have at least a background in accounting or finance, so that they have some basic knowledge. Not like my poor grandma, right? So all of those are the concepts that we've talked about. I should mention here something that I missed in that last slide, that one of our key concepts is the idea of relevance versus reliability and that trade-off between them. It's been a debate and an issue for a long time. So please make sure you're comfortable with the idea of what each of those mean, relevance versus reliability, and also why there's a trade-off between the two. Again, key concept, okay? All right, so let's continue on. The next section of our conceptual framework are the elements of the conceptual framework. Now, each of these have a formal definition. We're not going to get into the formal definitions. I just want to make sure you have a basic understanding, conceptually, of what these elements are. So let's start out with assets. And I could probably ask you what an asset is, and you would be able to tell me without any trouble. But since you're not here, I'll just give my definition. The assets of a business are all of the things that company owns that they can use to make money or repay debt. Everything that a company owns belongs in this assets section. Now, there's some limitations there, things that we can't put in, but cash, inventory, PP&E, right? We'll bring back our little truck. All of those things are assets of a business. Now, the next major element are liabilities. And liabilities have three parts. There could be loans, formal loans that we've taken out with a contract. There could be bills from our suppliers. We owe them money. And the other thing that there could be are what we call contingencies. Something we've done that might or might not cost us money, but we think it probably will. So for example, if I send out a coupon, some people are going to bring that coupon in, and I'm going to have to give them that lower price. If I offer a warranty, well, some people are going to break it, they're going to bring it back and expect me to repair it. Those are what I mean by contingencies, and I have an obligation to fix them. So really, a liability is an obligation to pay for something I have done or am doing. That's the basic definition of a liability. And again, there's these three elements. Next is our equity. And our equity, that's what our owners get. They're the assets of a business that belong to our stockholders or other owners. And there's two parts of this. Part one is the cash that they give us that we use to buy other assets and start the business or grow the business. The other part, at the end of each period as I make a profit, I can give the owner back money as a dividend, or a withdrawal is the other term for it. You can see it down here. Owner's original investment, that's what we're talking about right now. That's this. Or these withdrawals. If I withdraw it, that's a dividend. If I leave it in the business, I don't take the dividend, then we get what we call retained earnings. And retained earnings, they're the profit in the business that I as the owner haven't withdrawn yet. And that also belongs to me. Those are assets that I could have withdrawn and didn't, so they're mine. I will get them eventually. And that's the other part of owner's equity. Now, we can keep track of this in lots of different ways. The best shortcut is to take assets minus liabilities, and that gives us our owner's equity and what belongs to them. Okay, those are our basic concepts, probably the most basic, but there's also all sorts of other things that are elements of our financial statement. So let's talk about these. Revenues and expenses, there are the normal money coming in and money going out from running our business. Revenues are the money in, expenses are the money out. And it's not always money, right? Sometimes it's a promise for money later. People work for me, I'm going to pay them later 2 weeks from now on payday. People come in, they buy stuff on credit, they pay me later. So it's revenues and expenses aren't necessarily cash, but they're what I've earned, what I've spent on normal day-to-day operations. Okay, as opposed to gains and losses. Gains and losses, they're things that usually happen instead of in the store in our day-to-day business, they happen in our office building. Right? This is money coming in or profit coming in or going out from abnormal occurrences. So I sell off my delivery truck, right? My normal operation would be using the delivery truck to make deliveries of things I've sold. So the things I sold would be revenues. The cost to run that truck would be an expense. Selling the truck later, if I make money as a gain, lose money to loss, because I don't normally sell trucks. I sell the goods on the truck, right? That's the difference. So same basic idea, but it depends whether it's normal or abnormal. That changes it between gains and losses. Now the other idea we want to get into, other element, is what we call comprehensive income. Now comprehensive income, that's the stuff that changes our assets that we don't really control. Revenues and expenses, gains and losses, I make those decisions as a business owner or a manager, and it happens. Those are gains and losses, revenues, expenses, they become part of my profit. Comprehensive income, that's the stuff I don't control. So let's say I invested a bunch in the stock market and I lost a bunch of money. Well, if I've actually sold it and lost the money, then it's my fault. I sold it. If the market's just having a bad year and I sell it, that's not me. I don't control the market unless I'm Warren Buffett and so good that I can change prices. But if I can't change the prices, then that's not because of me. That drop of asset value is not my fault. Similarly, if the currency exchange rate changes, I have all these pesos that I can change into more dollars than I could, but that's not because I did anything, it's just because the peso went up. That's the stuff that goes into comprehensive income. So what we see, basically, is we see an income statement, and we have all the normal things here, and calculate a net income and an earnings per share, and then we add comprehensive income down here. And you should be familiar not with exactly how they're calculated, but just the fact that there is this comprehensive income that we can keep track of. All right, the next part of our conceptual framework are the assumptions. And we have to make several assumptions for us to do our job as accountants. The first is the economic entity assumption. And in that assumption, we're assuming that the business is separate from the owner. They are different entities, so they are not the same. The second is the going concern assumption, and that's the assumption that this business will continue indefinitely. Okay, now that could be a valid assumption or not a valid assumption. It's really interesting when you see a financial statement. One of the things that comes with it is the letter from the auditor, and sometimes what they will say is we have a going concern, meaning we're not 100% sure that they're going to continue going. Well, that becomes, unfortunately, a self-fulfilling prophecy, because when other companies see or banks see, oh, look, the auditors don't think they're going to be around, I'm not going to loan them money, I don't want to do business with them, well, now I really can't continue on, and I do go out of business. So oftentimes, a going concern becomes a self-fulfilling prophecy that way. All right, next is monetary unit. Monetary unit means that we can keep track of everything in the money of your home country. So here it would be the dollar, the yen, the peso, whatever it is. The last one is periodicity. And periodicity simply means that we can break time down. And report in certain periods. Draw a little calendar here with a beautiful flower as its picture. Okay, so we can break time down. We can report over a year or a month or 6 months or a week. We can report over a quarter. Okay, because we can break time down into manageable pieces and report over those pieces. That's the periodicity assumption. Now you can see most of these, for most companies, pretty valid assumptions, right? The economic entity, monetary unit, periodicity, pretty basic. It's that going concern that sometimes is up in the air. Okay, all right. The next set are the principles. And there are several key principles that we're keeping track of and that we follow consistently throughout the rules of GAAP. The first is historical cost, and this is one of my favorites. Basically, historical cost says we can keep track of things, or should keep track of things, at what we originally paid for them at their old historical cost, instead of trying to keep track of them at what they're worth now. This is a very conservative way of doing business or keeping track of things, is using this historical cost assumption. The next of our principles is revenue recognition. In 2014, so the year that I made this recording, they changed the principles of revenue recognition. Now there's 5 of them. The principles now come down to 5 elements, but there's 2 overriding principles. Principle number 1 with revenue recognition is that we've done the work. And number 2 is that we know we're going to get paid. We're going to get our money. Under these 2 basic principles, there are 5 new elements that we have to keep track of in order to recognize revenue. The first, we'll call it A, is we have to be able to identify a contract. B is we're going to have to find the obligations in the contract. C is that we can determine the price of that contract. D is we can allocate the price. And E is we're going to recognize the revenue as we complete the obligation. Okay, now that was a lot. Let me draw it out for you. Okay, basically, step A is we have a contract. And in that contract are going to be different lines and different elements. And we can go through those lines, this is B, and find that we have 2 things that we've agreed to do. Those are the obligations. Okay? Next, we're going to be able to look at that contract. We're going to find down at the bottom, this is how much they're going to pay us. Next, now that we've got the money, we can take that money and we can allocate it, some to this obligation, some to that obligation. And then as I do this work, I can show the revenue. As I do that work, I can show the revenue. The basic principles, again, are that we know we've done the work and we have to know that we're going to get paid. Once we're sure of those 2 things, then we follow this process to recognize revenue. Okay? And these are the principles of revenue recognition. And all of the revenue recognition rules come back to these principles. So those are our 2 principles. Let's go back, talk about these other 2. Matching simply means that I can identify my revenues and the costs, or the money that I spent, and I can identify this cost and this revenue match up, and this cost and this revenue match up, and this cost and this revenue match up, and I can keep track of the costs with the revenues that those costs made for me. Right? The last thing then, the last principle, is full disclosure. And the idea with full disclosure is that I will provide all of the necessary information from my investors to make their decision. See, he's very happy. He's got his thumb up here because he's very happy about the financial statements being right. Now, these principles form the basis of all the different rules. That's the idea. We're going to make sure that all the rules we create, or FASB creates, match up with these principles, and that they follow the assumptions, and that they contain the elements that we talked about, and that they have the characteristics that we wanted them to have, and they overall meet those objectives. That's the conceptual framework. The last piece here are the constraints, and this is the hardest piece for most of us. We don't want to feel constrained as we set up GAAP. We want to feel like we can do whatever we need to do to keep accurate records. But there are some things that limit what we do. So the first is cost benefit, and you probably remember this from basic econ. There are costs and there are benefits. And we're only going to do something as long as the benefit is higher than the cost. So we'll do it down here. Once it gets over here and the cost is too high, we'll stop doing it. Right? Sometimes we violate this. There are sometimes rules come through that are very extensive, and companies kind of push back a little bit. SEC has some rules. Congress has some rules that they've set up that push us to where it's actually costing more than we get any benefit for, except that legally we don't get sued. So that kicks in as a benefit, and we do it. But this is back to that idea with our expectations gap, right? We don't have an auditor at every single till, at every single Walmart in all the world, every single day, because it's just not worth it, right? That's the constraint, is that idea. The second is materiality, and we've talked about that before. And if you remember, Materiality is the idea, it's the point at which a rational investor, the amount of money at which a rational investor would change his or her decision. Boy, that guy's got a long arm. That's materiality. And so there's my cost benefit. There's materiality. Okay. Next is industry practice, and we talked about this when we talked about GAAP. Remember that we use common practice as our basis, and GAAP is built on practice. So we're not going to come up with a rule that's way out here, because nobody does it that way. It doesn't make sense. It doesn't keep track of anything. We're going to set GAAP that at least basically follows what makes sense for industry and what people are doing. And finally, the last idea is neutrality. Right? We want to be neutral in the decisions that we make. We don't want to be pro the business side or pro the bank side or pro the investor side or pro the IRS side. We want to be neutral and provide information that doesn't make the company look good or bad, but just provides an accurate picture of what's going on. Again, these constraints, they limit us. They limit what we can do and the rules we come up with because we have specific things that we want to accomplish. We're going to go ahead and stop there for now. We'll come back for one last segment and talk about IFRS just a little bit more and where the conceptual framework is headed. All right? We'll see you then.